Now is the time to make changes to your portfolio. Here's why. Recently, it's been smooth sailing in the stock market. Volatility is low, and the trend has been to the upside. But it won't be this way forever. Storms are coming. And to be clear, I'm not a market doom and gloomer, and I'm not predicting any specific decline in the market at any specific time. I don't even have a crystal ball. In fact, this upward trend that we've seen in the market could easily continue for the foreseeable future. But I do know that volatility will return at some point. We will get a correction, a bear market, or even a crash in the future. Corrections of 10% or more are a common and normal occurrence in the stock market, occurring on average every 2 years. Bear markets with 20% declines and market crashes with sudden declines happen too. This chart shows how frequently corrections in bear markets can occur. But this chart ends happily in 2018. We all know that the story doesn't end there. In fact, we've experienced a crash and a bear market during COVID in 2020 and another bear market in 2022. It's not fun to go through these events, but it's a normal part of stock market investing. And as a long-term investor, you have to expect to encounter these situations along the way. Despite this inevitable volatility, we have to stay invested all the time, or we risk missing out on the best days in the market. Because the best days in the market are the most important days in the market, and you'd better not miss them. Just take a look at this chart from Fidelity, which shows what would happen to your return if you missed the 5, 10, 30, and 50 best days of market returns. That's a lot of missed growth by just missing a few days. So this is the price we all pay to be invested in the stock market and enjoy its general upward trajectory over time. The price you pay is that sometimes the market goes down on its way to going up. But you don't know when the downward moves are coming, so the best thing you can do is get your portfolio ready. Your portfolio should always be prepared, like a Boy Scout. I think it's important to have a portfolio that you're confident in and that you can stick with through the market's ups and downs. And the way you can do this is by deciding on an asset allocation. An asset allocation will make your portfolio more or less sensitive to the market's ups and downs. How sensitive? Well, it all depends on how bumpy of a ride you can handle. An asset allocation usually starts with a percentage of stocks and bonds. When you're just starting out investing and through most of the period where you're accumulating assets, investors typically invest mostly in stocks because they have the highest expected return over the long term. So you might be 100% stocks or 90% stocks or 80% stocks or whatever. And the other 10 or 20% of the portfolio might be invested in bonds. As you get closer to retirement or when you're in retirement, you probably want to move to a higher percentage of bonds and a lower percentage of stocks. A popular asset allocation in retirement is 60% stocks and 40% bonds, the 60-40 portfolio. And you can see the difference in volatility by using Portfolio Visualizer and comparing a 100% stock portfolio to a 60-40 portfolio that is rebalanced annually. The standard deviation and the max drawdown is much lower with the 60-40 portfolio, but this comes at a cost. Less volatility in this case means less gains over the long term. So if you're in the accumulation phase of investing and trying to build up your portfolio as much as possible, you probably would want to stick with 100% stocks or something very close to that. But once your portfolio reaches an amount that's getting closer to enough, well, then you might feel differently. And you might want something a little more stable, like bonds in your portfolio, to make it less volatile. It also gives you some dry powder to invest with. If the market tanks and you have 100% stocks, you just have to ride it out until the market recovers. There's nothing you can really do. But if you have an allocation of bonds in addition to your stocks, well, then you can sell some of the bonds and buy more of the stocks when they're on sale. You could also achieve the same effect by keeping an allocation of cash or short-term treasuries, especially right now while interest rates are decent. But when you decide on your asset allocation, you're really deciding on what you want your portfolio to look like and how volatile you want it to be. Keeping in mind that the higher the volatility, the higher the expected returns over the long term. And your asset allocation isn't just limited to US stocks and bonds. You could have part of your allocation in international stocks, dividend stocks, or even alternatives like real estate or gold. There are many possibilities. So if you haven't decided on an asset allocation, think about how bumpy you want this ride to be for your portfolio. You can use a tool like Portfolio Visualizer to backtest specific asset allocations. If you're brave, you might be fine with 100% stocks. Totally understandable if you're in the accumulation phase. Because if the market dips, that presents you with a buying opportunity. Stocks are on sale, and you end up buying more stocks with the same amount of money because prices are lower. But if you already own a lot of stocks, if your portfolio is large enough that you get queasy when the seas are rough, well, then you might want something in the portfolio to smooth things out a bit. Ideally, you'd add another asset class that doesn't move the same way as stocks, something that provides a counterbalance to stocks. So once you've figured out your ideal asset allocation, the trick is to keep it there. But that's easier said than done because markets move. Stocks, bonds, and other assets change in value over time, which throws your asset allocation out of whack. The solution is to rebalance your portfolio. When you sell stocks and buy bonds, or sell bonds and buy stocks to get back to your asset allocation, this is called rebalancing. Because stocks typically outperform bonds and most other asset classes, your rebalancing will often look like selling stocks that have been doing well and buying more bonds or other assets that have not done as well. But it's not just stocks and bonds. It might be that you have an allocation of dividend stocks and growth stocks. Let's say you have an asset allocation of 50% growth stocks and 50% dividend stocks. And if growth stocks outperform to the point where the growth stocks are now 55% of your portfolio, well, that might be a great time to rebalance by selling some of the growth stocks and buying more of the dividend stocks to get back to that 50-50 allocation. When it comes to rebalancing, the standard advice is to rebalance at predetermined intervals. You could do it once per year, maybe on your birthday, or maybe on the first trading day of the year, or you could rebalance when the percentage gets too far out of whack, like if your asset allocation is out of alignment by 5% or more, then you rebalance. These are all valid strategies, but I think it's also valid to rebalance when market conditions are calm. That's why I think that right now is a good time. Yes, I think that now is a great time to figure out your asset allocation and to rebalance your portfolio. This is because the market volatility is low right now, seas are calm, and the storms are off in the distance. Or maybe there are no storms right now. In any case, I think that this is the ideal time to consider risk. It's like if you live in Florida and the hurricane is approaching, is that the time to buy insurance for your home? No. You better hope that you thought about that on some calm, sunny day when maybe rates were lower and you were in a better, clear-headed state of mind to make a rational decision on how much risk you are willing to take. But when the storm is approaching and you can see those dark clouds or the waves are already at your door, now you're panicked and not thinking clearly. That is not the time to plan for risk. So what I'm saying is that's the situation we're in with the market. Prices have never been higher. Volatility is low for now. Make your rational decision now with a calm and cool head, free from the emotion of fear. Buy insurance when the weather is good. Now is the time to really think about what you want your portfolio to look like going forward. And then it's time to take action by either setting your asset allocation going forward or rebalancing your current portfolio. Think about doing it now while the market is at all-time highs. If you already have stocks, especially growth stocks in your portfolio, you can lock in some of those gains by rebalancing your portfolio. Sell some of those stocks and buy other assets that haven't gone up as much. If you're primarily invested in a target date fund, you can do the same thing by switching to a more conservative target date fund that more closely matches your asset allocation. If you rebalance and make your portfolio less aggressive and the market continues to go up, I think you'll be okay with that. You'll still benefit, just slightly less so. What you won't be okay with, though, is if the market tanks and your portfolio is more aggressive than you want it to be and it loses a ton of value and that causes you to panic and make a bad decision in the heat of the moment. In other words, you don't want to panic sell when prices are down because remember, you need to remain invested so that you don't miss any of the market's best days. The bottom line is that the stock market is relatively calm right now, so it's a good time to prepare. Because there will be a storm and your portfolio should be ready for it. Another way that you can stay calm in a market downturn is by focusing on this number in a bear market. We have no idea how long this could go on for or when the market will turn around, but it will turn around. When it does, you want as many shares of your favorite stock or stocks as possible. So focus on that, is my advice.